Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic, all the way from the city of brotherly love. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you answers, provide you with guidance.
Excellent.
There's the disclaimer.
Righty.
So with that, let me share my screen. And a quick note, anybody join us for the first time, Will and I, we do this show in the morning to help answer any questions you may have about the Market Chameleon tools, the data, analytics. If you want to ask your question live, we provide a link to Zoom. If you click on that link, once you get over to Zoom, just click on raise your hand, then you could ask the question live. If you prefer to type your question, you can do that on the live chat on YouTube. Will's watching it. He'll read those questions back to me. While we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report, see if we could get some insights on stocks trading in the pre-market hours. After that, if we get questions, we'll take those questions. If we don't get any questions, I'll continue on some of our discussions we've been having in previous shows, waiting for any questions to come in. So let's start out with the pre-market report and take it from there. Okay, well,
perfect.
So pre-market report, these are stocks trading in a pre-market hours. I'm going to scroll down here and we have a list of our most active stocks, list of our biggest percentage gainers, list of our biggest percentage decliners. Here we got 57 stocks on our percentage gainers list, 31 on the decliners. So from this perspective, looks like we're setting up for a slightly more bullish bias at the open. I'm going to slide up here really quickly. Just take a look at this June 8th. Right now, we're on here, June 8th. And this box here gives us a high level view of what is going on in the pre-markets across the board. So we see there are 490 stocks that are trading higher in the pre-market hours than previous day's close. 222 are trading lower. As far as volume of shares, 95.7 million shares traded are trading higher. 33.4 million shares are trading lower. And if we convert that volume into dollar volume, right, because not every share price is the same price. So if we take the volume converted to dollar volume traded, we see $2.1 billion worth of stock traded up versus almost $900 million dollars worth of stock trading lower. So again, all this right now is showing that we're set up for a bullish bias. And if we come back down to this list, we'll see that the stocks on this list can be low cap stocks, ETFs, leverage products, pretty much anything traded on the major US exchanges. If it's trading in pre-market hours and meets our thresholds, we'll include it in the list. And what we want to do is try to narrow down the list to a smaller group of stocks. To do that, we could use the filters here above. So I'm going to use this one in ETF. Click on it. You get a drop-down menu. You get a bunch of ETFs to select from. The top ones are broad-based ETFs. The other ones are sector ETFs. Let's take a look at SPY. That's S&P 500 ETF. And click on it. The list below gets filtered by stocks that are holdings in the SPY ETF. Here, we see a little bit of more balanced, even, with three stocks making our percentage gainers list, 3 on the decliners. So nothing there that's really standing out. Looks more like neutral at the open from that perspective. So let's see. Give it a few minutes for more people to join. Let me know if you have any questions. Will, you're on mute.
Sorry, I just sneezed all the smoke in there. Nothing's popped up yet as far as questions.
Okay. So let's see what we could talk about. I'll bring up my paint. Some people like that, seeing something on a paint. And we've been talking about in the previous shows, talked about risk management, portfolio risk management of particular trade. So which is very important. We'll continue on that conversation, especially I think once we start pushing out a little bit more tools to help manage that part of it. But then there's also, I think one of the questions was yesterday about dealt with valuation models. And when you're looking at a trading strategy or pricing out a security, about overfitting, I think that was one of the questions. And really dealing with how to price securities. And pricing securities as a trader, it's one of the things that you're most occupied with. Okay, trying to find how do I price the security? What do I think? What do I think the value is of it? What do I think where it should be priced versus the market price? That's a lot of time spent and preoccupied on that. So let's just kind of discuss, some securities here. And let's just take let's say I'm trying to price a stock. Right. And to price a stock, I got to figure out, what data and factors go into it. So I got to really figure out all this stuff, factors that go into it, the data that I want to collect, the models I want to use. And this is it's not an easy or right answer because all these things are going to be subjective. Okay, so you're going to have to make assumptions. You might build different models to give you different answers for different things. What data you collect, how you clean the data, it becomes though an extremely important piece of the puzzle if you're going to be a long-term trader, especially if you want to see long-term success. And you probably want to start out saying, okay, I'm going to create a valuation model, right? So, I got to create a valuation model. And when it comes to stocks, you're going to have to divide it like this. And with most risk assets, there are going to be unknowns that will impact the stock price, right? And then you're going to have things that like data, analytics, news, that you do know. And this part, the unknowns, right, are going to impact the stock price because there are going to be events and news in the future that nobody knows about, right? These didn't happen yet. We have no idea. You could come in one day and anything could impact the stock market. And because those events are not predictable, like whatever it is, wildfire right now in Canada. Who would have predicted that? If that was going to happen exactly, and when and how it's going to, COVID, a war, something. These are all unknowns that are inherent risk in a stock, right? And those are going to, and those could be drive both ways, the stock higher or the stock lower. So since we don't know these things, right? We don't know these things. These are risks that are going to be on the table. And the only really thing we could do with this part, okay, is to, measure, risk and see, how you could hedge off some of this risk, right? So hedging becomes a big part of the puzzle. So if you have a big exposure to the market, systemic risk in your portfolio, you could hedge some of that, using indexes, SPY. If you have a lot of Vega risk, or if you have down, a big tail risk or whatever, you're watching it, because there's no way to know what news events are going to come out, later on, because nobody knows it. It just happens. That's part of the markets. It's part of life. It's part of everything we do. We can't predict ahead of time everything going forward. So these are things that really you got to be aware of. You have to accept that there's going to be unknown things that are going to impact stock prices, option prices, and so forth, bond prices. Then on this side, you're going to have other data that you'll have fundamental data, right? You'll have technical. You could try to do what else can influence the stock price? Stock buybacks. These are announced. Upcoming events like earnings.
Interest rates. Interest rates.
Interest rates, right? So all these factors, right? You have to write down, policies, seasonality, unemployment, all this stuff. We get data from, right? We get data from these. Let me see. And then we start to hold on a second. All right, I'm just going to leave it like this, right? So what we do is we run these through models, right, to produce us, either, a valuation of what we think what we think a stock should be worth versus what it is today, or answer other questions like, what do we think is more likely, to happen? So if we think a stock is, undervalued by fundamentals, then that could give us an indication, hey, if it's a good valuation, if we're looking at the same thing under other fundamental traders are looking at, that could create pressure from that trader cohort, right? From value people. If we're looking at the same thing, maybe technical people are looking at and saying, hey, these technicals, if other people are looking at it, this is more likely going to happen. It's going to create more pressure than on demand for the stock, right? Stock buybacks. If a company is announcing stock buybacks, then they're going to be buying back, their shares. And when they buy back their shares, they take the float out. that creates more demand on it. If the unemployment rate is dropping and people's salaries are going up, that creates more demand in stock for general, right? Because people open up IRAs, more people working, more pension funds, more people getting raises. That's more money that can go into the stock market. So then you create these, and what the reason you're doing it is saying, well, here, these unknowns are 50-50, right? So I could get lucky, I could get unlucky, whatever happens. There's nothing I could do to control it. I'm in the business of carrying risk, right? Then the knowns is the things that you could analyze, and if you could get a slight edge, right? What is more likely to happen than not, absent of good news or bad news, right? So what are the knowns, and absent of any kind of news coming out that is unexpected, which always happens, but in the absence of that, what do I think is more likely to happen if there's absolutely no other news going forward, right? Because all I could do is analyze what is in front of me, what I know. And the attempt there is to get a slight edge, right? Let's say I think there's a better chance, 55% chance, whatever it is, that the stock should go higher from here based on all my models, fundamentals, technical, everything that I'm putting in gives me an indication that the stock, based on these, there should be more pressure to the upside than downside. So that gives you a slight theoretical edge, right? That's what you're trying to do, is get a slight theoretical edge, because there's no way of 100% known the stock's going to go up or down, right? There's no way you're trying to get a slight theoretical edge. And then these other risks, right? These other risks, then you have, oops, sorry, guys. So what about your other risks? You're like, okay, well, but I got all this risks going on here. What do I do with these risks? Well, the risks are something, right, that you need to control, because they're going to exist, right? You do a risk trade unless you're doing some kind of great arbitrage that you've discovered. They're gonna exist, and so you have to manage those risks coming down, and then you got to decide how to manage it. So what you have to do is then define, you got to define your risks, then figure out your position sensitivity to each risk. Let's say you have interest rate risk. Let's say you have systemic risk. You have volatility risk. You have theta risk. You have tail risk. Whatever, you got to define them and see how sensitive your positions are, and then are there ways to hedge that risk? Can you hedge that risk and maintain this theoretical edge, right? All right. So let's just review from the top level. What do we do? It's like, okay, if we're gonna trade risk, we need to figure out some valuation models, some kind of metrics and models to give us a theoretical edge on things that we know, right? Data could be data, information, anything that we could feed into our models or analysis. We feed it in there, we test it out, we come up with something that we believe has a theoretical edge. All right. But we also know that there's lots of other stuff going on here that is completely out of our control, out of our hands. It's 50-50. That's what I'm saying is 50-50. Bad news, good news, who knows? It's random, right? I don't know if the next event is going to be good or bad. There's no way for me to for me to know something until it happens, right? So completely random, and I got to carry these risks. Although I think that in general, based on all the other data, I think that I have a theoretical edge. So that would be kind of like your starting point. What do I put into my portfolio, right? What risk, what risk do I carry? Carry in my inventory, just like a store, right? What are you going to carry in your inventory? If you're going to buy a product, you have a store and you buy a product, right? That's your inventory. You got risk now. Now you own something that you need to sell either. And think about it this way: what happens when you're managing a store? Well, not only do you have to, whatever widget you buy, you have to make a margin on it, but you got carry risk. Because if you put it on a shelf and it sits there, well, you're paying rent while it sits there. That shelf needs to produce income, right? You can't just let it sit there on the shelf for 3 years, because even if you make some margin on it, it'll get eaten up by all your other costs. So there are risk managements going on in every single business, right? Let's think of a grocery store. You go to a supermarket. Well, those products themselves are like options. They have expirations, right? Like you don't sell your, apples or your milk or your meat you got to sell it by a certain date or it's spoiled. That's it. Total loss, right? You got a total loss. You got to throw it out.
Yeah, that's one of the rough pieces of the restaurant business. This proper management of your food order and storage, and COVID killed them there, right? There was no you got some money for payroll a little bit, but nothing protected your inventory, right?
Right. And most products are like that, right? Because let's say a car, you can't there's going to be a 2023 car, but in 2 years, even if you have 0 miles on it, that car ages, right? There's going to be new cars, and holding on to that car, there's a carrying cost, right? You're putting it on a lot, you're taking care of it, you're maintaining it, you're paying for parking, whatever it is. And those are all things that you have to manage. And sometimes you have things in your inventory you got to let go for losses, start over. Sometimes you got to let go things in your inventory because there are other opportunities and you need the capital. But you're always looking at the model between, okay, why am I getting into this risk? Do I think that there's a good chance that I will have, there'll be some kind of a profit margin in it? And then how do I manage all the risks associated with carrying this in inventory, right? It's got to be modeled out and mapped out for you, so you could trade and manage this efficiently and effectively. Okay, not like you can't just be a degenerate gambler and make it work. You have to map it out that you're more efficient and effective, and things make sense to you, and that you could, you could react and make better decisions, right? So the points that I'm trying to make is that in trading, it's not about looking at some kind of a signal or indicator and trying to rush, like that it's a race or something to do something fast. There are lots of components in there to make it work, to make it work in the long term. And each one of those you need to handle and put them together. So hopefully as we go along, we'll do them piece by piece. But again, it's not about a single tool. It's not about a single indicator or a signal that you're sitting there and trying to race into it. There are lots of things you need to consider in a successful trading system. Okay.
That's awesome, D. We did have two questions that popped up. I didn't want to get in front of this process you were going through. But Robert asked, do we have a filter for stocks and the respective analyst ratings, i.e. how many analysts are positive or negative and who did them?
Yeah, we don't have a filter for that. I think you could go out there and get these ratings for free in other places. So anything that you could easily get for free, we try to manage the website in a way where we make investments for the community that are things that are not easily available for free, or that they create value, their value added to our existing products. So if we can't either add value, or we don't know how to add value using some of these data points, or we think you could just easily get them somewhere for free, then we try to go and make an investment where that whatever we do with our limited budgets, we're creating the maximum value we can for you guys. Okay, so if you're getting analyst ratings, if you could go like wherever, Benzinga or Yahoo or whatever, if you get them there, right? Well, for us to purchase that data and maintain it, and
maintaining it's a big piece.
The maintenance of it is very
really
big.
Expensive.
Right. It takes away from resources of, other critical data and information that we believe we can add value, that we could create models, or we could improve our models to help you guys. So we focus on that. So like right now we're trying to integrate with a lot of your brokers. So, we're going to the brokers, trying to integrate with them, and that takes an investment and maintenance. But we think it's important that if you could import if you could easily import your positions and do analysis on your positions and analysis on your risks, and improve your trading that way, I think that's much more valuable than bringing in a list of analyst ratings that you could get somewhere else. And what do you do with those analyst ratings? It's like, because we don't know, when it's a rating, we don't know what models or what assumptions and stuff they use. So there's no way for us to validate any of it. All it is just somebody put out a rating. And by the way, stock prices, just like we're looking at it right now, just look in front of you. How do you put a rating on something where these data points are continuously changing? Like, how do you put out a rating, a 6-month rating, and say in 6 months, I'm going to hold my rating as is, when circumstances, data, and information is changing on a continuous basis? So these are the things you need to consider, where, where the stock ratings, what do they change it? Like some people change it once a year, once every half a year when something really, significant happens.
And Sarush asked, and he wanted an explanation of theoretical. Where is that theoretical edge? What makes a theoretical? I mean, we're up at 9:30, so we could take this tomorrow. I'll copy and paste it. But he asked question: what makes a theoretical edge fade away or appear? Thank you. So
Yep.
I'll send that to you, and we'll answer. That'd be a good one. Theoretical edge, maybe something we haven't talked about in a while. We could go over it tomorrow. Awesome job, buddy.
All right, everyone, thanks for joining. Stay safe out there. Have a great trading day, and hope to tomorrow, right? Hope to see you guys tomorrow.
Yeah, Friday. Just remember to wear the masks today if you're in plus 300 particles per square, whatever. The air quality is still really bad. Be careful out there.
No, for sure. Yeah, I see it outside from my window.
Orange suns, lots of dust on the car. It's really quite an event here in the Northeast.
Yeah.
All right, my friend. We'll talk to you later. Have a great day, everyone.